right, good afternoon, everyone, and welcome to Vancity's 2023 Financial Literacy Month series of webinars. I'm Marella Gazzola, Regional Director for Community Member Services. Today, I would like to acknowledge that we are joining you from the unceded territories of the Musqueam, Squamish, and Tsleil-Waututh First Nations, who have been custodians of this land for thousands of years. I would like to pay my respect to the elders, both past and present. We are hosting a free webinar every Thursday in the month of November featuring topics of estate planning, retirement planning, and investments. Today's webinar is on navigating current market conditions. This webinar will be recorded and shared with all registered attendees and will also be posted to our YouTube channel following the event. If you haven't already, please make sure you follow us on YouTube and our various other social media platforms to stay connected and get across to great content like this webinar. Finally, we encourage you to engage with us throughout the webinar and take note that what's most valuable to you and what might be helpful to you. The Q&A button will allow you to submit questions at any time, and we'll be answering these questions following our presentation. With that, I'd like to introduce to you our speakers. First, we will hear from Mark Sherd, Portfolio Manager Equities. Mark joined VCIM in 2021, bringing 15 years of industry experience. Previously, he spent 8 years at British Columbia Investment Corporation, serving most recently as a portfolio manager for a global active equity fund. Prior to that, he worked as an investment analyst at Insurance Corporation of BC, and as an analyst at the Toronto Stock Exchange. Mark holds an Honours Commerce degree from McMaster University and the Chartered Financial and Analyst designation. Next, we have Kelly Hirsch, Head of ESG with Vancity Investment Management Limited. She's also responsible for assessing the policies and practices of publicly traded companies to determine eligibility for investment. Kelly is involved in developing and executing shareholder engagement strategies as a component of portfolio risk management. Kelly holds a Bachelor of Environmental Science from the University of Guelph and a Diploma in Accounting from the University of British Columbia. She's a CFA's charter holder and is certified as a Responsible Investment Specialist with Responsible Investment Association. Following the presentation from a resident expert, Barry Osmond, manager of Vancity Investment Management, will be moderating the Q&A and will also be providing closing remarks. With that, over to you, Mark.
Thanks, Marella, and hello to everyone on the call. Thanks for joining us today. As Marella said, my name is Mark Sherd, and I'm a portfolio manager on the equity portfolios here at Vancity Investment Management. And my goal today is to make sure not to inundate you with too much information, but instead give you a high-level overview of what's been happening in the markets, why we are optimistic about the future, why you should be optimistic, and most importantly, why it's time in the market as opposed to timing the market that matters. But first, what I'd like to do is actually go back to last year, as what is happening now is in many ways a continuation of what we saw in 2022. So if we could just turn to the next slide, please. So there's obviously a lot happening in the markets last year, but we thought when you boil it all down, there are three major topics that can really summarize the year. The first is rising inflation, which was brought upon by a number of factors, and it's a lot more complicated than any of us care to admit. But for the purposes of this presentation, two of the major drivers were issues with the supply chain and a lot of pent-up demand that was built up during lockdown. And these two forces really combined to push inflation to extreme levels. And what's important to note is that the speed and the absolute level of peak inflation, which we hit in June of last year, was extremely difficult to predict. Even the US Federal Reserve, whose job it is to keep a very close eye on inflation, was surprised, and for the longest time was saying that they expected it to be transitory in nature, which with the power of hindsight, we now know was way off the mark. And this is really just another reason why it isn't a great use of time for any of us to be sitting around forecasting what will happen in the economy. It's just way too difficult, if not impossible. And you still have to answer the most important question, which is, what does your forecast mean for the markets? As often the result is not what you would expect it to be. So you can get everything right except the impact, which is really the only thing that matters. So of course, rising inflation resulted in rising interest rates as central banks were forced to become very aggressive in an attempt to cool the economy and thus bring down inflation. And raising rates is by far the strongest and their most impactful tool. So this led many people to believe that we were headed for a recession and a hard landing, with one economist calling it the most forecasted and expected recession in history. In October of last year, 100% of economic forecasters on Wall Street were predicting a recession within a year. Yet here we are about a year later, and not only has the economy avoided a recession, but growth is actually accelerating. And finally, all of this culminated in very negative market sentiment, which pushed markets into a down year, as we'll see in a second. Just turning to the next slide, this takes a closer look at the Bank of Canada policy rate over the past 30 years. And if you look at what has happened over the past year and a half, which is on the right-hand side of your screen, it really was unprecedented in terms of how quickly rates rose, but not so much in terms of where rates moved to, as we've been above this level 4 times before over this period. And I think that's a really important distinction. The speed of the rate hikes, which came after years of near zero rates, had the biggest impact on not only bond prices, which move inversely to rates and have struggled the past couple of years, but also consumers who are already dealing with rising prices on everything from groceries to gas, and now had to worry about higher loan and mortgage payments. It was a massive jolt to the system, as it happened over a relatively short period of time, as opposed to a more gradual increase, which would have given the economy more time to adapt. And I think this also shows just how concerned the central bank was in terms of rising inflation. They knew full well how this rapid jump in rates would impact consumers and thus the economy, but they went ahead nonetheless. If we look at the situation now, however, rates are near their highest level in many years. Central banks appear to be close to the end of the rate hiking cycle, as we'll touch on in a bit. So we see a really good potential for bond yields to shift lower in the near future, which would cause bond prices, of course, to appreciate. But the last couple of years have been difficult, due to the shift in rates, and bonds have struggled, as we show in this next slide. So if we could just switch over, please. And what it's showing is the total returns for the FTSE Universe Overall Index from its inception in 1979 to September of this year. So in layman's terms, this index includes all investment grade Canadian bonds. So any Canadian bond rated BBB or higher. And as you can see, it has been very resilient over the years. I mean, prior to 2021, there were just 3 calendar years with negative total returns, but we're now currently in our 3rd year in a row of negative returns. So this really is new territory, which, combined with a weak equity market last year, it's created a lot of angst and concern amongst investors. 2022 was the first time in this index's history to have 2 consecutive negative return years. Not to belabor the points, but in this next slide, what you see is a history of U.S. Treasury bond bear markets. So it includes all the times that U.S. Treasury bonds fell by more than 10%, and it goes back to the early 1800s. And even when you extend back that far, what we've seen recently, it still stands out, and it's at the very top of this table. It's the worst peak to trough performance of all time, with a drop of almost 25% and a duration of about 28 months. So from July 2020 to October of last year. And this is just another set of data that leaves us confident in future returns. The pendulum has swung really far in one direction, and when that happens, it generally doesn't stay that way for too long. As you can see in this table, the recovery following a downturn is generally quite strong. So it's those investors that can hang on during the difficult periods that'll reap the rewards. As an investor that is much smarter than myself, once wrote, it's out of crisis comes opportunity. You make the most of your money in a bear market. You just don't know it at the time. Now moving on to the next slide, and I won't spend too much time on it, but it's looking at last year's equity market performance. And as I already said, markets were hit by negative sentiment as investors speculated that there was apparently no other option but for the economy to enter into a recession. And this resulted in money flying out of the equity markets, and the S&P 500 fell by almost 20%, while the TSX held in relatively well. It was down about 9%. And if we look at equity returns a little more in depth, as we do on this next slide, which shows sector returns, The only sector that did well was energy. It was up 41% in the world index and 24% in Canada's main equity market, the TSX. While higher growth sectors like information technology and consumer discretionary were amongst the worst hit. I actually can't remember this type of sector skew over my entire career. It just went so far in one direction that it was inevitable that it would come back at least somewhat in the other direction, and we'll touch on that in a bit too. Now moving on to the next slide and coming back into 2023. If we go back to the beginning of this year and we think about what was top of mind for investors, as I said, it really was a continuation of last year's concerns with some slight tweaks. The war in Ukraine was still, unfortunately, front and center, and as we all now know, we also have a war in the Middle East, which seems to have no end in sight. Inflation was a concern, although the sentiment shifted somewhat from rising inflation to falling inflation, and we'll touch on this as well. Rising rates were still a hot topic, but again, increased expectations around the pace of rate hikes slowing. And now I would say most expect that we're either at or near peak rates. And finally, fears of an impending recession were still around, although the commentary moved from a hard landing to a soft landing. And now I would say they are moving into the camp that we will not enter into a recession at all. Yeah, I should also note that there really isn't a year that goes by where there aren't a number of major economic concerns at some point during the course of the year. Someone told me last year that what was happening was very unique relative to what happened in prior years, and I agree. It was very unique, as was every other year. No 2 years are the same. A major pandemic that shut down the world in 2020 was unique. A major financial crisis that put the U.S. economy and thus the global economy on the brink of collapse in 2008 was unique. I mean, there's always something for investors to worry about. But what's interesting to us, however, is that while all of this energy and time is being spent by investors trying to forecast what will happen in the economy and the implications, markets have already moved on, as you can see in this slide. And this is showing equity market returns up to mid-November. And the US market, again, represented by the S&P 500, and the global market, which is represented by the world index and in gray, they're up by about 18 and 15% respectively this year, although Canada has lagged at just over 4%. This is why we don't spend a lot of time trying to discern the direction of things like inflation and rates, because these are not only impossible to forecast, but as I was saying earlier, the impact, it's often the exact opposite of what you would expect. I mean, at the beginning of the year, nobody would have expected markets to be up by so much if you had told them about the conflict in the Middle East, the absolute level of interest rates, and how inflation is still well above the central bank's target rates of 2%. But the market, it's forward-looking, and it's very anticipatory. And while investors try to time inflections, it's already moved on. The equity market, it's a brilliant compounding machine, but the cost of entry is volatility, and you have to be able to stomach down markets. When I talk to younger people especially, I really stress this point. If you're starting to invest in your 20s, I mean, there's absolutely no reason why you shouldn't be able to have an extremely comfortable life, no matter how much money you make. When time is on your side, the biggest headwind to compounding your money at a good rate is yourself, as most of us will struggle to simply leave our money invested, ignore the constant flow of negative news, and just sit on our hands. But this is really a superpower, if not the superpower when it comes to investing, being able to do nothing. And unfortunately, for most of us, that is very difficult. And just looking at this next slide, what this is looking at is the TSX, so the Canadian equity market, represented by the blue line, versus the world index. And as you can plainly see, there's been a fairly wide divergence between the two in terms of performance. And this has come up a lot this year, which is why I wanted to highlight it. But the main reason behind this divergence is that the returns for the world index, it's being driven mostly by US mega cap tech companies. So think of companies like Facebook or Apple. And there really are no comparable companies in Canada, which is, of course, very resource and bank heavy. The current US market, it's very divided, with tech companies leading the charge. And of course, the Canadian market, it's a lot different than our neighbors to the south, as our market isn't as exposed to those types of companies. But it's also the reason why, of course, the TSX outperformed its peers last year. And on this next slide, we just break down the market returns by sector. And I won't spend much time on this, but there really is an important point and lesson for all of us on this slide. Earlier we looked at sector returns for last year, which showed energy way up while higher growth sectors were amongst the worst performing. This year, however, it's almost a complete reversal, although energy has held in well so far. But the leading sectors year to date by a country mile are the sectors or areas of the market that investors ran screaming away from last year. And this is why, VCIM, we spent so much time last year looking into these beaten up areas for, new possible additions to the portfolios. Over a short time period, say a year or less, investor sentiment drives share prices. And if you can avoid this noise, it's times like that when you can purchase, very high quality companies at attractive prices. It's not generally in the areas of the market that are outperforming where you find the hidden gems. You have to dig through what has been thrown aside. And that's why this year we've been focusing some of our efforts on companies in the healthcare space and consumer staples sector, as there's a lot of short-term narratives that are driving down their share prices of some really attractive companies while the rest of the market focuses on tech. And this next very noisy slide, it looks kind of like a heart monitor reading. What it's highlighting is the monthly price returns in percent of the S&P 500 going back to 1958. So basically, how much the index moved on a monthly basis. And when you first look at it, it really doesn't appear to provide a compelling reason to invest in equities. And that's because the trend in stock prices, which is up and to the right over this period, it's lost in the noise of the short-term volatility. But if we step back from this noise, what we're going to find is that investors over this period would have realized an annualized price return of over 7%. But volatility is a very normal part of investing. Over the last almost 100 years, the market has experienced a 10% plus drawdown in the US about 2/3 of the time. So seeing 5% plus moves in either direction over just a 1-month period, it's not unique, as you can see. And it's simply due to the fact that, again, investor sentiment drives share prices over the short term. Just think about all the major events and drawdowns that occurred over this period. How many people can, honestly say that they wouldn't have been affected? It's only human to watch your money fall, 5 to 10% and start getting nervous. I mean, we have such an aversion to loss that it dwarfs all other reasoning. And inversely too, I mean, what about all the times that the market moved up by 5 to 10%? I mean, most investors will look at a paper gain and they want to sell out so they don't have to face any potential future losses. Again, these are all hardwired human biases. And the goal isn't to pretend that we won't be affected, as we all will be. The goal is to be honest with ourselves and understand that these biases will eventually come to the forefront. This is why it's best for investors to create as much friction between themselves and the bad habits that lead to these paths of wealth destruction, such as concentrating too much on short-term performance or focusing on the constant negative headlines that comes at us from every angle. I mean, I often tell investors to look at the portfolio and the markets as little as possible. I honestly believe that we would all be better off or better served if the markets were only open a few times a year. And the best thing most investors can do is absolutely nothing. And yet at the same time, it really is the most difficult thing for most of us to do. Now, returning to the topic of inflation, this slide is showing monthly CPI readings for Canada, which is in blue, and the US in orange. And CPI is, of course, a measure of inflation. And after hitting a peak of about 8 to 9% in June of last year, we've seen a relatively steady decline in the growth rate, although we are still above the central bank's 2% target. But what's important here isn't so much the absolute level, but the fact that we're seeing an improvement in the growth rate. Uncertainty, it drives the market crazy. And when inflation was steadily creeping up, no one was certain as to where it would peak. But now there's a belief that we're long past the peak and we're going to continue to see a decline, which is very positive for equity markets, partially due, of course, to the sound reasoning that this will lead to interest rates holding firm or even falling in the near future. And as you can see on the next slide, which shows the Bank of Canada interest rate increases on the left and US Federal Reserve on the right, the level of rate increases has dropped by quite a bit over the past year and a half, and we've now gone 2 sessions with rates being held flat. I would never attempt, of course, to guess where rates will head from here, but it's difficult to fathom a world where they move much higher, and expectations right now are for rates to actually fall next year. Again, this is a very positive setup for both bond and equity markets, although history has shown us over and over again that the markets are an investor's friend, where the odds are in our favor. So moving on to the next slide, this chart goes back about 80 years, and what it's showing is that the equity market, it's really a collection of bull and bear markets with much more emphasis on the bull markets in blue, as you can see. And so when people ask me what I expect the markets to do, this is exactly what I refer to. I expect the markets to move up and to the right with occasional downturns kind of interspersed between these upward movements. And I think when you show people a chart such as this, they can really understand what you're trying to convey, but then not long after, they'll go back to watching BNN or talking to their neighbor, and the conversation moves towards inflation or the potential for a recession, and all logic, goes out the window. And I know I keep saying this over and over, but time is the greatest advantage you can have in the markets. And this slide here really shows you why. And what it's highlighting is the percent of periods that US stocks earned a positive return. So on any given day, which is the first bar on the left-hand side of your screen, it's about a 52% probability, which is pretty good. Well, on the right-hand side, at 30 years, it's 100%. And this chart looks back all the way to 1871, and at every single period amongst that time, from 1 day up to 30 years. So even looking over a 1-year period puts the odds at 68%. I mean, casinos are making billions on much worse odds than that. Again, the odds are in our favor. The only thing that stops us from growing our investment at a solid rate is ourselves. And one of the more comforting facts that helps myself when I'm starting to let the market kind of skew my thinking is to remember this slide. And what it's showing is the last approximate 30 years of earnings per share growth of the S&P 500, represented by the blue line, versus the actual index. And although there are times when the market will kind of move away from earnings growth, over the long term, it's earnings and not sentiment that drives share prices. Eventually, the market will catch up with fundamentals. I mean, this is why we spend our time looking for companies that can grow their earnings in a sustainable manner over time, as the share price is going to eventually follow. And this next slide, which is my final one, and I have shown this before in some variation. This table, it goes back almost 100 years and up until January of this year, and it's comparing the returns for an investor if they had just simply stayed invested every single day in the market versus missing the best 10, 20, 30, 40, and 50 days, which is what you're gambling with when you jump in and out of the market. And the difference in returns is dramatic, especially when you consider the fact that over this period, there were over 34,000 trading days. So if you miss just the best 10 days, or in other words, 0.03% of the days, you make more than 1% per annum less, which adds up to an incredible amount over this period. And if you miss the best 50 days, or just 0.14%, your returns are cut down to only 1.7% versus almost 6% if you had just done nothing, which is a really sobering thought. And that is everything from me. Thanks again to all of you who joined. I'll now pass it over to Kelly, our head of ESG, who will give an overview with some highlights from our recently published shareholder engagement reports. Kelly?
Great, thanks, Mark. So I'm here today to just give a little more color. So Mark's covered some of on the financial side of sort of what we're looking at, but I'm here to outline a little bit about our ESG process, as well as some highlights of some of the shareholder engagement work that we do. So to start, I think it's really important to, given how in the past couple of years, how ubiquitous, sort of the term responsible investing, ESG, et cetera, that has been, I think it's really important to define what we're talking about before we get into this. So when responsible investing is really just about looking beyond just sort of purely financial metrics. And I think to help conceptualize it, again, so ESG, environmental, social governance. So it's really looking at these factors that is responsible investing. And there's two main pieces. There's looking at, how companies impact people and the planet. I like to think of this as, their actual business. A renewable energy company is going to have a different impact. The impact that their products and services have is going to be, different than, let's say, a tobacco company that would generally be a more negative impact on, people and health. And then the other side, so there's that actual, products and services and sort of what the company, the core of the company's business. Then there's also looking at, it's not just what a company, produces, it's also how they do that, how they operate their businesses. Do they, are they evaluating climate, the climate risk that their business faces? Are they ensuring that, they have a diverse, inclusive workforce? And looking at really those internal operations. So I'd like to think that's a good way to conceptualize those kind of two components when we're looking at RI. So before I start, because I'm going to be throwing around the term ESG a lot in this presentation, I think it's important to define. So with the E, environmental performance, it's really looking at how a company is impacting the environment. How, and not just, I think often when we hear environmental, factors, we think, climate change, which yes, is a key important area, but it's also looking at, biodiversity, looking at, how a company is managing potential, pollutants or toxins that could be part of operations, how, sort of how they're managing water inputs. And then for, the S, or, social responsibility. This is looking really holistically at both how a company is managing, sort of how they're treating their employees. Are they creating an inclusive, supportive environment for them? Are they ensuring, that they have a good place, where they can thrive and really create value for a company? And then as well, sort of how it's not just about a company's employees. It's also looking at, sort of how are they treating the community? How are they ensuring, if there's, a project being undertaken, are they consulting the community? Are they, really ensuring that, they're part of the community and benefiting them? And then, going even further outside of their operations, it's also looking at, in supply chains. Are they ensuring that, sort of that not just their own operations, but sort of how the suppliers that they use, what sort of practices are there? How are they ensuring that, sort of the values that, if a company has good values, how are they ensuring that those are throughout their supply chain too? And then something that can often in the ESG be overlooked is the governance piece. So really, corporate governance is a key component of how a company can actually achieve some of the the environmental and social sort of goals and like good practices that they can have in place. And that it's really looking at that sort of oversight of operations and ensuring that a company is being well and efficiently run. And so on the next slide. So Mark has covered on the sort of the financial analysis side, in a sense, and how we look at markets from that perspective. I'm here today to cover both. I'm going to go through very briefly a bit about how we actually apply ESG analysis, and when we're looking at a company, because I feel like that's a term again thrown around. And what does that actually mean? What does that look like? And then as well, I'm going to cover a little bit of a couple examples of our shareholder engagement work and sort of how that, how being shareholders and how being invested in these companies, we don't just benefit from the company's growth, we can actually help move companies in the right direction and, see them really, help drive the positive change that we really need to see in the world. And it's really it's the integration of these pieces that is really, I think, the special sauce, the value that we provide. So this, just a quick overview. So when we're talking ESG analysis, this is something where, and I'm referring to VCIM's process here. But so when we're looking, we look really holistically. It isn't looking at just, sort of the environmental aspect of company or the social or the governance, sort of in isolation. It's really about looking holistically at these 7 components that you see on the slide here. And ranking companies, looking, a company may be very good in one area, and there may be some, sort of a weakness in another area. And often that can be an opportunity for engagement that I'll be getting to later. But I think this is important to understand, because this can be implemented differently in different places. So for us, we've been doing this since, so VCIM, was founded in 1995. And ESG has been core, and responsible investment has been core to our process since then. It's not sort of a fad, an extra thing that we've added on. This analysis process really helps us make good investment decisions that, help reduce risk as well as increase value in the long term. And so I think this is important because often there are a lot of funds that, and I think it's important to understand when you're making an investment in an ESG fund or an RI fund, it's important to understand what they actually mean, what that investment manager is doing. Because there are cases where it would be looking at, you may be more, a lot of people are more familiar with, let's say, with a bond. A bond can be the credit, quality or credit rating. And so there are similar pieces for companies. And so you may have an ESG fund that is looking at sort of a rating that a rating agency and one of the sustainability rating agencies has, assigned to that company. And that would be, they may be looking at these factors and come up with one sort of score, and then that's how that's incorporated. And today I'm going to be walking through, in a sense, a bit of why I think it's important for us for that holistic look, and often you can't take this all into one number. It's really about looking at, sort of what are the material risks and how do those impact a company. So this case study here that I'm going to quickly walk through highlights how really the value that our ESG integration process adds. So here I want something that we've looked at. It's really looking at how do you. So for instance, if we're looking at water risks, for instance, how is that integrated into equity analysis? So this is something where I think you may, I know it's been topical over the past year or two at points where water shortages is becoming a big issue in many parts of the globe. And I'd say very close to home, we've seen some very serious in the US Southwest. The Colorado River, which is really the lifeblood of the region, providing water to a number of both agricultural and industrial users, as well as the populations that live there. And it has reached record lows with where there have been water cuts have been required. We've actually seen, for instance, there's a suburb of Scottsdale that actually has had their water cut off, and they're having to truck it from outside. And some of these water cuts that have happened, we're looking at in the future to actually help restore the Colorado River so that it can continue to provide the water that is needed in the region. There will have to be future cuts. And so that's something where this is a big ESG risk that companies operating in this region face. And so when we're evaluating companies, that's something that we're looking at as well. So this directly translates to financial risks. And so for instance, we were evaluating a company at Pool Corp, a distributor of swimming pool related products and services. When we're looking at them, they've got good health and safety programs for their employees, a lot of, community involvement and engagement, they have decent governance practices. But when we started looking through the environmental angle, we noticed that, okay, so they actually have a lot of exposure to areas under a lot of water stress, with 54% of their revenues being derived from California, Texas, Arizona, and Florida. And so in this case, I mean, how are they addressing that? How are they managing those water risks? And so when we were taking a look at this, they're very exposed. Private pool, so they install private pools, which is a pretty low, if we're looking at like where water's going, that's one of the lowest priority and probably one of the first areas to be cut. We're looking at this, and once we start evaluating, we're not seeing the management practices in place. We're not seeing the appropriate risk management of this issue. So this was something where our holistic approach actually helped us avoid making this investment. And we actually identified a company that could replace them in the fund that was focused on drought-tolerant landscaping and had good, the same good practices in place. So I hope that's sort of a helpful as to how that holistic look and really diving into a company, diving into, the geographic regions that they're operating in and where they're, sort of in how they're managing those risks, how that can really add value to the investment process. On the next slide here, so now I want to jump into a bit of our shareholder engagement work. So just before I go into sort of some of the more details, just want to quickly give a brief overview of what shareholder engagement can look like. So there is, shareholder engagement at Vancity can look like. So there is direct dialogue, and I mean that's really we have frequent conversations with companies on a variety of ESG issues, ranging from their climate strategies and how they're implementing, sort of how they're both mitigating risks as well as, looking at the opportunities that, sort of where are they looking to get into, sort of businesses that are, areas where we need to see development, taking advantage of programs, like the U.S. Inflation Reduction Act, which have a lot of incentives for companies, that are providing a lot of the solutions that we need to reduce carbon and address climate. We can also, this can range, there's a wide range of issues, but for instance, we could be talking to a company about their wages and, ensuring that they're paying their employees a living wage, which is what a person needs to meet their basic needs, such as rent, food, etc., in the region that they live in. And then that can sometimes lead to, those direct dialogues can sometimes lead to filing a shareholder proposal. And so a shareholder proposal is basically a formal, sort of as shareholders, we own the company, and that in many cases gives us the right to ask a company, it's a formal ask for them to undertake, it could be an analysis or implementing a particular policy. So for example, we actually filed the first shareholder proposal in the US asking a company to implement a paid sick leave policy that covered all their employees. And so if we do that, that gets brought forward for a vote at the company's annual general meeting for all shareholders to vote on. And so that actually goes into the third channel of engagement, proxy voting. So as shareholders, in the companies we hold at their annual general meetings, we are, as owners, we have the right, to vote on different measures. So some of this can be voting, for or against board members. It can be voting, for or against the company's, often called say on pay votes, but basically voting, do we support a company's executive compensation practices? And then tying back to the shareholder proposals, That's where through proxy voting, you can actually have even greater impact beyond the proposals you we file ourselves by supporting other shareholders who bring forward proposals at companies, let's say asking a company to improve their climate risk strategy, for instance. And so on the next slide here, this I highly recommend, and I think it'll actually be sent out in at the follow-up email, our shareholder engagement report that was recently published and goes through a comprehensive coverage of some of the engagements that we've undertaken and the impact that those have had. So we did this year implement a new framework of looking at the 7 key impact areas that we want our engagement to have, that we think, will both help. It'll help our help our company, the companies we invest in do better, and it will also help, more broadly when we're looking at sort of society. It will help address broad societal issues. So I'm going to walk through now just highlight a couple examples of work that we've done in the past year in some of these categories. So to start, I'd like to highlight in the climate, energy, and just transition category. This is obviously a big focus for us with with the 2030 coming up, where there's a lot of interim targets that we really need to, as a globe, we really need to be making progress towards, because it will get us on track to be hitting, net zero, where we by 2050, which is very important for helping stabilize the planet's climate. A big component of this is energy is very important, but we need energy that doesn't have the associated carbon emissions that we have, that fossil fuels generate. And so finance is going to play a key part, the financial system is going to play a key part in this. According to the International Energy Agency's flagship net zero report, we actually need to see clean energy investment triple by 2030 to 4 billion. And so we need to see, in a sense, fossil fuel financing limited, and we need to see that financing going to clean energy instead. And so when we're looking at, we are fossil fuel free across our funds. So we don't engage, we generally being not invested in oil and gas, we're not engaging directly with oil and gas companies, but we look at being able to engage with financial institutions that we invest in as a great way that we can make a significant impact here. So on this, issue of needing to limit financing of new projects and, ensuring that this finance is directed to clean energy, we filed we actually use the term shareholder proposal, and shareholder resolution can be used interchangeably. And so that's why you see here when I say shareholder resolution, I am referring to shareholder proposals that we filed with Canadian banks. Last year with TD, CIBC, and Scotiabank. And we voted for a number of climate proposals that were filed with RBC. And these were about ensuring that the banks are working with their clients to help their clients transition, as well as ensuring that they have a process in place for clients that are not transitioning to, direct that financing away from them. And then as well, looking at, what is the definition of sustainable finance? Ensuring that they're funding the projects that, we need, that they have, good, credible criteria there to finance the projects that we need to really, ramp up our renewable energy generation and get that, get us energy that doesn't have the associated carbon emissions with it. On the next slide, so then I think this is an important one. So I think often when we talk environment, we think climate. And it's really important, we need to look more holistically. And it's why at VCIM, we have focused as well on what we call biodiversity and nature. And I think of this really as looking at ecosystem health. We rely heavily on healthy ecosystems to drive our economy. There have been, estimates done where about 125 trillion value was actually generated through ecosystems, whether that be, pollinators, looking at, sort of kind of like wetlands that can form, storm protection to help minimize losses from hurricanes, just as a couple examples. We've seen some research that shows the already present decline in many ecosystems is costing the global economy $5 trillion annually. So we look at, food, energy, infrastructure, and fashion are 4 key areas that are driving a lot of this pressure on biodiversity. We then look through, so this is something in our process, we then look through, the holdings that we have, and this is where we identify, Costco is generally a great company undertaking a lot of good work, especially with their employees, and some of that, that human capital management side. But this was something where we saw an opportunity here for the company really to take a leadership role on managing biodiversity risks. And so we filed the shareholder proposal with the company, asking them to evaluate the risks, that they face in their supply chains through, sourcing the products that they then, that they rely on to drive revenue. And this is a good example of all shareholder proposals don't necessarily, they will often go to a vote at the AGM, but our goal isn't necessarily to have that vote. Our goal is for the company to undertake the action that we're asking them to. And so this was a case where we actually had, and we filed the proposal with Costco. We had a number of discussions with them, and then we were actually able to come to an agreement where the company is currently, so they are undertaking a pilot project with a materials supply chain where they are looking to evaluate where they're potentially impacted, where they could make some changes that could, help improve some of that management. And so that's one example of sort of how that shareholder proposal process can work and can sometimes go different ways, but still, really achieve that positive result. And so we don't just engage on environmental issues, we engage on a broad, both in the social and governance side. And so on human rights is continues to be a pressing issue. Unfortunately, we live in a, sort of a messy, complicated world where there has been, there's been a lot of issues. Obviously, there are issues in parts of the world where they don't have the same labor protections. We don't have, sort of those pieces, but we think that it's very important for companies that we hold to ensure that they're not driving their practices and their suppliers are upholding the same standards they hold internally. And so we've been, and the reason, and this is particularly important right now, as human rights due diligence legislation, which is basically, it takes different forms, but it's basically countries are implementing legislation where companies need to show that they are undertaking steps to prevent human rights abuses in their supply chains, and that, sort of that they're, and in some cases can potentially have shipments actually stopped at the border. And so that would have, can have a direct financial impact on a company. And so in light of, we've engaged on human rights for a long time, but in light of, sort of recent developments in different areas, we've been focusing on some high priority sectors, such as companies held in apparel, solar, and technology, to see them really and to work with them and encourage them to get better supply, to continually improve their due diligence processes. And that to make sure they can really identify potential violations and ensure that they rectify that and improve. So finally, I just want to, so I think it's important, our work, so I think many engagements don't fit nicely into sort of one area. They can have a lot of different impacts, and that's where our engagement asking Canadian financial institutions to disclose the CEO to median employee pay ratio is a great example. It impacts, it's good, in our opinion, it's good governance and disclosure to provide that information publicly. And then it helps on the, human capital management side, and as well as, financial resiliency. because we're looking at, sort of year over year, we've seen, these increasing gaps where executives are making more, sort of their pay is going up higher than we're seeing the average workforce go up. And we think this is an important metric, especially in light of, rising inflation and cost of living. This is a really important metric for, responsible companies to be evaluating. So for instance, to give this, so Vancity, we recognize that this is valuable, and we've disclosed this annually for a number of years. Vancity has a ratio right now of 14:1. This is compared to, we have better, the US, it is mandatory, and if you look at the average of that, it's actually 344:1. And so Canada, there is no mandatory disclosure, and that's something that we think should change, and we would like to see companies start disclosing that. Given the place that Canadian banks hold in the economy, and given the influence they can have on other companies, this is something why we have been filing proposals and encouraging the Canadian banks to start tracking and disclosing this metric. We have, so Scotiabank has, as a result of our engagement, they now disclose this ratio and will continue annually. And we will continue to work with the other banks and hope to see this disclosure in years to come. So I hope that was a helpful sort of overview of some of our engagement work. And I highly encourage you to take a look at our shareholder engagement report, and I'll pass it over to Barry now.
Thank you, Kelly, and thank you, Mark. Great information, and appreciate the questions that are posted from our audience members. So I'm going to take the next little while to navigate through some of the questions here. And the first couple of questions I'm going to pose to Mark, if that's okay. Mark, the first question, we hear most of the market returns come from a handful of big companies, while the rest of the market is lagging behind. Could you please expand on what's driving the market returns?
Yeah, thanks. Thanks, Barry, for that question. We touched on this a little bit in my presentation, but I can dig in a little bit further. So if you look at the US market specifically, I mean, it's up, almost 20% year to date, but it really has been driven by those mega cap tech companies that we all know and use daily, Microsoft, Alphabet, Facebook, etc. And these indexes, what it's important to know is that they're market cap weighted. So the largest companies like Apple, make up a much larger percentage of the index than smaller companies. And so Microsoft is about 5% of the index. Apple is somewhere around there too. And these often can drive the index returns. And so if you look at what's called an equal weighted index, so instead of weighting it by market cap, you took every company that's in the S&P 500 and gave them an equal weight, what you'd see is that index is basically flat for the year, flattish. I haven't looked in a couple of weeks. And so you have the S&P 500 up almost double digits, but if you equal weight it, it's maybe slightly positive now. Again, I might be off by a little bit, but I'm not far. That's a massive difference. And the breadth of companies, or the number of companies that are outperforming this year, is amongst the smallest it's been in years. And so it has actually made it a pretty difficult market for a lot of investors. And what's happening, in my opinion, is last year, everybody ran screaming away from tech companies. Everybody wanted to invest in energy companies. And so the valuations of some of these brilliant companies like Microsoft, I mean, who of us can live without Microsoft products? It went down to ridiculous levels. So you could buy these great companies with this recurring revenue, pricing power for really low valuations. And everybody started moving in to these names at the end of last year. And this year they've just gone straight up. And the people, we have a bit of a herd mentality, to be completely honest. We all have this fear of missing out on what's working. And of course, everything that worked last year doesn't mean it's going to work this year. So as soon as people started moving into these tech companies and they're releasing these very strong earnings, everybody just got right back in. And so the S&P 500, it's really being driven by these massive mega cap tech companies. But again, that doesn't mean it's going to be the same next year.
Thanks for that answer, Mark. And one more question your way. Around the U.S. elections and how they impact the markets. As we know, next year, the U.S. Will be going through their election cycle again. And the question here is around how can investors protect themselves from any potential political changes in the U.S. and how that could impact the market?
Right. Yeah, no, that's actually a good question. And I haven't looked at the data in a few years, probably since pre-Trump. So my memory is a little bit fuzzy, but I have actually looked at what equity markets have done going back decades during a general election. And overall, it was quite positive. So if you look back at equity markets, returns are about 7 to 8%. Really depends on the time period, but 7 to 8% is generally what people will say. So the year heading into an election, it was a little bit below this. Again, my memory is a bit fuzzy, but it was around 6-ish%. I don't think I'm too far off. And then the year after, so the 12 months after an election, it was actually better than that. So it improved. But I think the important point, well, there's a couple important points here that I want to note. One is that the markets were positive, the equity markets were positive leading into an election and after an election. And think about all the interesting, US presidents we've seen. From former actors to former presidents' sons to, Donald Trump. I mean, the markets have actually been pretty good heading into and after these elections. But one other thing I just want to note is be careful about saying, okay, I'm going to try to protect myself over this one major event, because you can't really pick and choose when you want to get in and out of the markets. Like I was saying, we don't really know what's going to happen over the next 2 years, but the odds are on the side of the markets doing well and continuing that 7 to 8% return. So I'd be very careful about getting in or out, based on something like a general election.
Thank you for that answer, Mark. And I really like what you shared in one of the slides around missing the best days of the returns of the markets and how that impacts the overall returns for our long-term investors. So to your point around, not trying to time the market and taking a long-term approach when it comes to investing and planning for the future. So really well said. Thank you for that. Kelly, I have a question coming your way, and it's around some of the sentiment that we're noticing in the US with respect to ESG type investments. The question that's posed to us that we hear some American investment firms and some pension funds are shifting away from ESG investing. Could you please speak to this, and what does this mean to ESG in general?
Yeah, thanks. That's a great question. And it's a very top, so something we're definitely following closely. I think it's something, it's in many ways, I think it's in some of what we're actually seeing there is there's a politicization of a lot of issues in the US, where things sort of go, there's like a good or bad, a duality to it. And I think the truth is always more more complicated than that. There's always where there may be, there are cases where I've seen, sort of ESG funds, there are legitimate concerns about greenwashing. I don't know if what I've seen sort of happen in terms of some of the, sort of the red states and government, like that doesn't, to me, it seems very political and not necessarily based on real concerns, with greenwashing. But at the same time, I would say that the industry it's very new, and it's in that it's maturing, and there may need to be people are right to be concerned, but I think that some of the concerns, especially when I see what's happening in the US, it doesn't seem to be very based in the actual issues and that side. I think, but at the same time, I think it actually highlights why it's so important for ESG investors such as us that are leaders. It's really important for us to communicate and help people understand what ESG is, what it can, sort of the value that it adds, and help investors be able to differentiate between good ESG and good RI funds and ones that may not, may have a lot of marketing but not a lot of substance behind them.
Great, thank you for that answer, Kelly. And I think with this, we come to the conclusion of our presentation. I just want to take a moment to thank Marella, Mark, and Kelly for this informative session. And I also want to thank our audience members for your questions and your engagement and participation. And just want to remind our audience members that the information that you heard here is general in nature, and each person's investment circumstances are quite unique to themselves. So we highly recommend that you reach out to a wealth professional. We're happy to speak to you here at Vancity. You're welcome to come in and see us at any of our community branches or contact us online. And we're more than happy to speak with you and sit together and put together a proper plan that meets your overall financial objectives while taking into consideration all of the different investment solutions that are available to us. Also would like to remind our audience members, if you could take a moment to fill out this survey and complete the survey. As you can see, there is a QR code on the screen here. We'd really appreciate it. It will help us fine-tune our presentations and ensure that we cover topics that are really important to our audience members. And just a last reminder, as you know, this is one of our financial planning series topics and financial literacy topics throughout November. So please, we invite you to join us on the next one around the legal aspects of estate planning. And that's happening next Thursday, November the 30th. So with this, I'd like to thank you all for your time and wish you a great rest of your day. Thank you, everyone.